The Rebel Capitalist Show.
Let's we talked about the tipping point for inflation and the tipping point for World War II. And it seems as though a lot of times that tipping point or that final snowflake that causes the avalanche can be psychological. It's not just something that's a quantitative, in the size of M2, that it's like a psychological shift in society. And that's something that I'm seeing right now in the United States that I've never seen. Even during the GFC or even during these, times in the past decades, I've never seen the media and just normal people talking about price increases and getting very frustrated to the extent that I'm seeing people talk about that today. Do you think that's another tipping point we should really look for?
Yes, and I think it's even more extreme over here in Europe. I think I think that also to some degree explains central bank policy because I think that the U.S. and the Federal Reserve is still kind of traumatized by the Great Depression, which led to the deflation. Or I mean, we can talk about that at length, and I think everybody should read Rothbard on that. While over here in Europe, Austria, but especially Germany, is traumatized by hyperinflation. So I think if you talk to people here, for example, about physical gold, people have got a completely different attitude when it comes to physical gold. You can buy it in every bank. You can buy it basically all over on TV. They're making commercials now that you have to buy some gold coins for your kids for Christmas. So I think here where inflation is probably for historical reasons much more of a concern and of a topic. I think people are way more sensitive, and I mean in Germany we had numbers coming out, going higher and higher. We had the PPIs coming in at I think 16% in the Eurozone, which will translate to the CPI at least to some degree, while the ECB is still doing basically nothing. So, George, I think last year we had a chat when we published our special study on inflation. It was called "The Boy Who Cried Wolf,"
Yeah,
and
right.
and we chose the topic because we said, well, many people and many analysts were shouting hyperinflation already after the GFC and then in 2011 and 2013, and nothing happened. But now the third time or the fourth time, we should be warned that inflation is really becoming a concern, but nobody is listening, like in the fable by Aesop. Now, back then when we published the study, CPI in the US was at 1.2%. Now it's at 6.2%. So we saw a dramatic shift. George, I don't think that it will go, one straight line up, but I think that going forward, the great moderation that we were basically brought up with, those 4 of almost 5 decades with inflation going lower and lower, I think this is over, and I think that going forward people will have to prepare for higher inflation scenarios. So 3, 4, 5%, perhaps even higher. But the thing is, I mean, we had such high inflation numbers already quite often in history. But the big problem is, I don't think that the bond market will be able or will be allowed to reflect those inflation numbers.
What are
So I
bonds
think
trading in the Eurozone? Are they still negative in Germany?
yeah, they're still slightly negative, and I think
Oh,
Greek debt is still at a lower yield than US 10 years. So it doesn't make any sense. But of course, I mean that leads us to financial repression. So, for example, we manage a couple of funds, as you know, and we wouldn't be allowed to buy physical gold in most of our funds, while it's perfectly fine to buy 10-year Greek debt, for example. We can even take enormous amounts on leverage on that. So what I mean by that is money is being funneled into directions where it would normally never go to. So we are already in this scenario, but long story short, inflation is a topic again, and I think it will remain a topic.
You know what's interesting, when you were saying that, I'm thinking about a chart of the CPI in the 1940s in the United States. And we had three significant price increases there, or spikes, let's say, at the beginning of the 40s, the middle of the 40s, and at the end into the 1950s. And in 47, inflation as measured by the CPI got up to 19%, while they had, I believe, the long bond pegged at 2.5%, something like that.
Yeah.
Now, what's fascinating, obviously, those bondholders were just getting their butts handed to them, and a loss of purchasing power. But what's fascinating is if you actually look at the interest rates toward the end of the 1940s, they actually went under the Fed's target, which would imply that the Fed didn't need to buy the bonds, at least during that time frame, to keep them sub 2.5%, while you saw these significant spikes in inflation. And so it's like the bond market is telling you, what the bond market is telling me, Ronnie, and I think the gold market as well, and I'd love to get your opinion on this, is that we're going to continue to have a lower global economic output. And so therefore, the bond market is maybe telling us that, hey guys, we're not at the 1970s yet, but we are at something that looks very similar to the 1940s, where when the government comes out and let's say they can agree for 6 months, and they come out with these $5 and $6 and $7 trillion, which I think we'll see in the future, spending packages that are just pure deficit spending, then you're going to see these big spikes up to 6, 7, 8, 10, 15%, even as measured by CPI. But then when the governments and the politicians cannot agree, then all of a sudden those deflationary pressures kick in again. And then you see inflation go back down to, let's say, 4 or 5% until the government spends a ton of, trillions more, and then it spikes back up to 10 or 12. Something like the 1940s, as opposed to the 1970s, where inflation, you kind of saw higher highs and higher lows all the way up to kind of a crescendo in 79 or 80. What do you think about that?
Well, that's an interesting thought. I mean, I would say that the 1970s inflation was primarily driven by food and energy price inflation, and therefore I think I always have a hard time comparing the current setup to the 1970s because the world changed dramatically, and therefore I think we should also take geopolitics into account, globalization, and so on. I think that, for example, one driver for inflation that is very much underrepresented in a discussion is the renminbi. We shouldn't forget that China and basically China joining the world market, massively devaluing the renminbi. I think in 1994, when they devalued the renminbi by more than 50%, they unleashed the Chinese labor force.
Right.
It was such a big deflationary force unleashed to markets, and now I think this is kind of reversing. I think it's very, very interesting to follow closely the renminbi and the strength of the renminbi, to follow what actually the People's Bank of China is doing. I think Charles Gaff he called the PBOC the basically the new Bundesbank. So I think this is also one important driver in this equation. But as you're coming up with the 1940s, I've got one chart in my slide deck, I think, which is very, very interesting. And if we look at the velocity of money, so I always want to emphasize that inflation is a process. There are always time lags involved, and I know that Austrians are a bit critical when it comes to the velocity of money. They speak about the demand to hold money, which is more correct. But if we have a look at this chart, we can see that in both 1933 and 1946, the velocity of money was at similar levels. Now it's actually even lower. And in both cases, the US government resorted to radical measures. We all know in 34 they devalued the dollar against gold by almost 70%.
Right.
And 46 till 51, they basically, in cooperation with the Federal Reserve, enforced dramatic financial repression. So I think it wasn't called a yield curve control, but this is what they actually did. So I think that we should not rule out similarly extreme measures going forward. And I think, if we make a comparison, if we compare, now with the whole Omicron scare, if we compare that to early 2020 when the whole Corona crisis started, back then the Fed funds rate was at 1.7%. Now it's still at 0%. The Fed's balance sheet was at 4 trillion. Now it's at 8.6 trillion. The Schiller PE was, I think, at 31. Now it's at 40. So I think we should not forget that the traditional toolbox of the Federal Reserve now is basically exhausted. We already saw that, our friends in Frankfurt, the ECB, in the last cycle, they didn't even hike once. But now I think also the Federal Reserve is in this zero rate trap. So there's not too much they can actually do. I think that a yield curve control will be implemented at some point. I think that they will at some point also start buying equities. But this basically confirms my view that now fiscal policy will take over. And let's face it, I mean, Janet Yellen coming in at as the Treasury Secretary, as the former head of the Federal Reserve, I think the symbolic character is quite telling. It's the same with Mario Draghi now being the prime minister in Italy. So I think this much closer relationship between monetary policy and fiscal policy is really something that that was caused by this tipping point of the Corona crisis,
Right.
and therefore I think that basically we should really focus less, and I have to remind myself as well, because all financial market participants, they try to anticipate what the Fed's gonna do next, but what if they aren't in the driver's seat anymore? I think that it will be. I think that at some point markets will realize, well, we shouldn't care too much about Jay Powell and Lagarde. We should focus more on what the White House is doing.
I completely agree. I say on my videos quite often, I think we've gone from a Fed put to a government put.
Yeah.
And that people, if unfortunately we live in a time where to answer economic questions, you have to start by answering political questions.
Yeah.
And I think that's we definitely see eye to eye there. And if someone wants to figure out what's going to happen with the stock market or anything, you got to start by saying, okay, what on earth is the Biden administration going to do, or what is Janet Yellen going to do, or is Omarova? I don't know if you saw his nominee there for, I think it's comptroller of the currency, but she was someone that was very, very, let's say, pro central bank digital currency. She's someone that's talked about the Fed or the Treasury actually buying and selling the S&P 500 to micromanage the level of the stock market. I mean, she is. I mean, she is a central planner's dream. Like she's, if you went to your computer and tried to create a central planner, out would pop Amarova,